Is there any, Rick, so any detail you want to talk about, like composition, like what are the holdings for model 1 and how do you model 2? What are the differences you have on that?
Yeah, I'll show you actually what I
Okay.
sent out for February positions. I actually show
Sure.
you that and show you the worksheet that we use to build out or to make the trades, the portfolios.
First year, second everything. Yeah. Of course, we are here all the time. I was here.
Sai, you can mute.
Okay.
Okay.
So do we need? There seem like there's one or two more on here. Are we good?
Yeah, I think yeah, we can start.
Okay. I am recording this one, so we'll have it in two parts. Anyway, how the program works is once a month you're going to get new allocations for your trades, and that comes out in terms of a spreadsheet. And I post that in a private Slack channel. And when you become a member, I'll give you access to that private Slack channel. If a new subscriber comes on in the middle of the month, I'll go back and rerun the algorithms to determine the positions. Or if somebody wants to set up a different portfolio and do that, I'll go ahead and rerun those programs again to get the new allocations. And right now, the way I post the performance summary is when I post the new positions at the beginning of each month, I'll put in there how each portfolio has done so far. And currently there are 7 portfolios, and as I continue to do research and study, I may add portfolios or I might take portfolios out of this, but I'm always trying to refine this and get it even better. So I continue doing work on that. So for your technical asset allocation membership, you get new allocations every month. So that's all you have to do is once a month, just make adjustment to your portfolios. You walk away from it. You don't have to sit in front of the computer. You don't have to get alerts that you have to jump on your computer and hurry and trade. And it's pretty easy to do the allocations. You can even put sell orders in for your positions on the night prior to getting the new positions. So, you can start fresh at the beginning of each month. Or what I do is I just go ahead and sometimes, let's say you're in gold and you have 100 shares of gold, and the next month it says, oh, well, you need to be 120 shares. Well, instead of selling 100, then buying 120, I'll just add 20. You get all the strategies. We'll have a private Slack channel that I support and answer questions through, and I'll give you detailed information on how these model strategies work. So if you want to go do your own research and understanding them, I'll give you all the background on how those strategies work. So the membership price on that is $900 a year, and that's non-refundable. That's for a whole year. If you even doubtful at all that you don't want to do it for a whole year, it's $75 a month. But what I've done is I've made a discount code that you guys can use. I've known Ravi for just a short while, but kind of doing that as a favor for him with the discount code. And what I'm going to do is I'll knock off 3 months of that. So it'll be $675 for a year. And I'll have to give you what that discount code is, Ravi. I think it's Smart Investor. I'll send out an email to you, and
Sure.
I'll give you the link of where you sign up, and I'll include the discount code for you. And again, you can do it monthly if you want to try to do that. If you want to just check it out. But you get 3 free months if you do the whole year. And these are just some of the things that I use to get some of that information. Portfolio investing from Trading Dominion is the course you can take. Yeah, it's only $397, but you learn a lot in that course. Allocate Smartly is one of the tools I use. I use Portfolio Visualizer, Logical Invest, and if you want to do it yourself, I can help you do that too. But you're still going to be spending a lot of money to get this going, and you're going to have to do all your learning and trial and errors and building your model portfolios and everything. So you can go either way on that. I do this to help my friends out. That's originally how this was put together. And I'm just trying to make it easier for everybody. But I want to help cover some of my costs, and that's part of the reason we do this. That's the last slide. So let me go show you some things now. let's see, get out of, there we go. All right, so here's the spreadsheet that I send out at the end of each month or beginning of each month. And how you use this is you go in here and you say, look, do I need to zoom in on that? You can see these numbers.
We can see the numbers.
Okay. So what you're going to do is you put in the size of your portfolio. If you have a portfolio less than $10,000, this is not worth doing. But because the cost of the course, the cost of all this research and stuff is you won't make that up in your trading. But you know, for anything more than $10,000, it's worth it. You put that amount up here. And then let's say that you only want to trade 80% of your money using this strategy. What you're going to do is you're going to say other equals 20%. So then you decide how you want to allocate the rest. So the way this is divided right now is that there's nothing going into the commodities. Index trader 1 and index trader 2 have 10%, $20,000 going into those strategies. Nothing's going into portfolio model 1, but 20% in model 2, 30% in model 3. So again, these are the most conservative strategies right here. So there's 50% of the portfolios going into these conservative strategies. And again, these all really outperformed SPY. And then if you want to have kind of like a supercharged group of trades, then you go into Riot 3X, and this is showing 10% into there. Over on the left, it shows what and this is at the end of January, what the returns right here are. The different strategies on here. You see up almost 10% in January for those two strategies. Just 0.25% on model 1. Model 1 was actually in cash. And what we do with cash is we go and you can either leave it in cash or you could buy some like a G-bill or something like this that returns a dividend every month. And it really is just kind of like a treasury ETF that pays dividends. And I think G-bill is paying about 4% a year right now. There's another one that I'm using. I think it's HYG. And HYG is probably returning about 6%, 7% a year. So they're very conservative investments, ETFs to have money in. Anyway, so this was all in cash in the first month, and this is the February's allocation. So I don't have the performance yet of February. Again, Model 2 is all in cash or into these G-bills. That's why it's only got a 0.25% return. Model 3 was actually in a position in January, and it's up, 2% for January, which not a whole lot, but over a year, that's 24%, which would be fantastic. And then the Riot as the algorithm decides on how to allocate them. And so this is kind of the working information for the different strategies. When you're going to just fill out what's in this orange right here, your amount that's in your portfolio, and how much you're allocating to each of these. And then this uses a feature from Thinkorswim that you can go and get prices, right from Thinkorswim, the RTD function. I don't know whether you're familiar with that, but if you have Thinkorswim running and load this spreadsheet, then these prices will automatically get updated for you. If you don't,
yeah, we use this.
Okay, good. And so since it knows what the price is and it knows how much you've allocated at $20,000, which is that here, knows how much you've allocated, it knows the price, it can tell you how many shares to buy.
Yep.
So you just go down here and say, okay, well, I need 103 shares IWM. I need 1,216 shares of VINEX. And you just work your way down and build your positions. One of the other things I do is within Thinkorswim is I'll set up groups on the monitor page, and then I'll, put these trades in those groups so I can monitor each of these different strategies. within Thinkorswim. And the other thing that I provide for you is
Hey, Rick, can I ask you something?
sure.
So I think I get the point of buying, right? Allocation. When do you get rid of the stock? Like, how do you get?
You sell it, and at the end of each month, it will tell you whether you can stay in it or to sell it.
So every month you update the Excel and I need to react to it monthly basis.
Exactly. So what's nice about it is you don't overtrade. I mean, sometimes you're seeing the price going up on the stock, you buy into it. Oh, now it's going down. Oh, I'm going to sell it. Oh, it's going back up. I'm going to buy it again. And, you get caught in this whiplash here that, you just lose money trying to chase something. But this will tell you, this will actually run algorithms, to calculate these numbers and calculate which things to trade. And these algorithms will decide when it's time to get out of the market. So it takes the emotion out of it, and it, protected us before the 2022 market pullback. So it was really nice to be able to do that. What I've provided here is how many years of historical data that these models are based on. And then I look at the correlations between these products for commodities or index traders. And if you want to kind of look at something and you want to say, okay, well, I want to trade Model 3, but I want something really not correlated with it at all. So I can say, okay, well, maybe I can get into commodities and I'll get some, maybe some Riot or something. And that's kind of a nice way to be able to decide what you want to do. Here's another way that you can decide. I've gone back in and calculated thousands of combinations of different allocations for commodities, index traders, Model 1, 2, 3, and Riot. And so in this case, here's 35% going to Model 1, 35% Model 2, and 30% into Model 3. And it has 11.5% return over. What you got to do when you figure out this return is you got to look at the products that are included. So Model 1, 2, 3. Model 1, 2, 3 has 35 years, 34 years, 36 years, and take the smallest number, which is 34 years. So this combination that returns this 11.5% is based on 34 years of history of using this algorithm. And it had a standard deviation of 7%, which is really low. Sharp ratio of almost 1.6, which is incredibly high, and a max drawdown of only 7% in that 34 years. So you can see how it protects your money and keeps it from, being wiped out. And I got, like I said, there's a lot of combinations down here, and I've sorted them by Sharp ratio getting smaller. So I'll go all the way down. Let's go to the bottom just to show you I have. Yeah. 868 combinations that I've done calculations on. And so if you might be able to get a higher return, but then you might have a bigger drawdown, or maybe you want smaller drawdowns. So you can kind of sort this out however way you want to meet your.
So Rick, just real quick. So I'm not following this model thing. So your proprietary model, right? Whatever the algorithm is. So what is the pseudo logic behind it? I mean, I don't need to know exact details. So what exactly are you doing behind the scenes?
Yeah,
Like at a high level?
The model is based on 3 different trading strategies, and those are all derived from investment papers done by PhDs, and taking those investment papers and putting it to code and combining all 3 of those investment strategies into this model. So I just give it an arbitrary name called Model 1. But again, it's made up of, I think Model 1, Model 2, Model 3, I think 1 or 2 of those have two strategies or 3 strategies, and if you want, I can provide more details of which strategies those are. And I can actually point you to the research paper that describes what that investment is doing and what its goal is and how to determine what it trades.
Yeah, that'll be great, Rick.
Okay.
Okay. So Rick, if someone investing money, that means they are transferring money to your funding account, or you are managing their account without their transferring money? How does that work?
You trade your own account. I don't manage anybody's money.
Okay. So we keep on our own accounts then. So what are we getting out of this? Basically, you're suggesting which one to allocate, which one not, kind of thing.
If you allocate, if you want to invest the Model 1 portfolio, these are the positions to be in.
Okay.
You're going to be in 12% is going to be in cash.
Okay.
Your 88% is going to be in these other products.
Right.
It tells you how much to invest in each of these other products.
Okay.
And I'll show you what I do in here. So here's Slack, and I have an option traders channel and the tactical asset allocation group. And so this is where I publish the February allocations. So you can go in here and you can just download what I'm showing you, the spreadsheet.
Okay.
And then you can determine what allocations you want to make. And your determination on what you set up here is going to be how conservative or aggressive you want to be.
Right.
Yes, with money, with maybe the biggest risk in this case, and go all in on Riot. Riot right now probably wouldn't be a bad strategy to be in because the market has pulled back so much that we still have some potential downside, but I think that most of our downside risk has been played out in the market. I suspect we're going to see some lower lows from where we are now, but I think that in 2 years, let's say, we're going to be a lot higher than we are now. I don't think we're going to be lower. And so if you got into this Riot right now, and with it making 100% return in a year like it was doing the years before last, it can make your portfolio really grow.
Okay.
But you also have to know which position to be in. For example, like this right now is in TNA, which is the Russell, and that UPRO is the S&P 500. It may switch this over to TQQQ, which is the NASDAQ, but it's using its algorithm to determine that. And I found that algorithm to be pretty uncanny on picking the right one to be in. So these are using what they call a dual momentum model, and dual momentum models look at different time frames on how they've increased, and then calculating the score on those different time frames, and then looking at that score compared to the other products. And if these products, it picks the two highest scores, and if there aren't two high scores above holding it in cash, then it will go ahead and put you in a cash position or an alternative bond position. So, but it's using that algorithm to watch the market and see what it's doing, and then tell you it's time to get out or it's time to change.
So Rick, just so that I get it again, right? So behind the scenes, you have a set of assets, let's say inventory of assets, maybe 100 of assets, right? Your algorithm is looking at the what are the papers or whatever, and figuring out of these assets that you already have, which one makes sense in the current state to put it in portfolio 1 or 2 or 3, and then you update the Excel. Is that the summary of the point?
Yeah, and it doesn't really care what the current position is. So when it figured out the February, when it figured out the February allocations, it didn't care what was in January, but it looks at its bucket of potential investments, and then makes a decision based on that.
Right. So where I'm struggling, Rick, is that let's say in January, your algorithm gave me a list of assets, right? To put it in, let's say, portfolio 1, right? So when I put that into the portfolio visualizer, which I use today, it's going to tell me that it's going to be performing better than SPY, for argument's sake, right? However, in February, your asset allocation has changed because algo thinks it's different now. So again, I go back to visualize, update it. So I'm just confused on how do I make sure that my portfolio is always outperforming SPY because you're frequently changing it. You get what I'm saying?
Yeah, if you're using Portfolio Visualizer, what you're going to see on there is that it has a lot of different strategies that you can use. You can moving averages, dual momentum, all the different things like that. But what you'll see on that too is that you're going to give it a list of stocks that you're or ETFs that you're going to invest in, and then you may have a back history on it that says, oh, well, these stocks really did good, but that's all, kind of back testing on against what they've actually done. Whether they do that going forward, who knows? But the other thing that happens on that is that you're going to have a timing period where you say, well, I'll make reallocations every month. And you go back into your timing periods on Portfolio Visualizer, and it'll say, okay, for this month now, instead of being in Microsoft and Oracle and Apple, I want you in Google, Amazon, and Facebook. And so, it changes you based on when it goes back and looks at that timing period. Does that make sense? You understand? You use Portfolio Visualizer enough that made sense?
Yeah. I'm just still trying to track with you. Maybe I need to digest a little bit. So in this particular example that you're sharing, right? Model 2, let's say we're talking about model 2, okay? So I'm taking, let's say 7 of your assets that are there, right? That's one portfolio I put in the Portfolio Visualizer, right? So
okay,
now I'm comparing, go ahead.
Yeah, those Model 1, Model 2, Model 3 don't use Portfolio Visualizer at all.
No, I'm saying I'm going to use it. Let's say sure. I'm going to build a portfolio using the Model 2, okay, for argument's sake, okay?
Okay.
So I create that model in the Portfolio Visualizer, and I'm now comparing that model against, let's say, S&P 500, okay, for argument's sake, I'm just saying, okay? Now, the composition of the Model 2, changed from January to February. Composition changed because your algo changed. Is it fair? It changes, right?
Yes.
Right. So what happens is that now I go back to the Portfolio Visualizer, and I now go back and change the mix of the portfolio model, right? So now this new model is going to tell me I'm going to perform better than S&P 500 again. However, the previous model that is out there was also there, right? So I'm struggling to figure out how do I take every month when I'm changing the model, how do I make sure it's current and making sure it's performing better than S&P 500? That's what I'm struggling to grasp.
Yeah. Well, I don't know if it would perform better if you took these and put it in the Portfolio Visualizer and then ran. I don't know what you're running on that. Are you looking at moving averages? Are you looking at dual momentum? Are you looking at RSI?
The standard stuff. RSI.
Yeah, I know, but there's a lot of different analysis that Portfolio Visualizer does.
Okay.
And I don't know which one you're talking about, but there's a lot of them are probably not going to do as well at all. And they're if you want to try to replicate doing that, it'd be tough to be able to try to get those numbers in there.
Yeah, that's what I was thinking. Okay, got it.
Take a look at. Let me get the name of that for you. Take a look at logical-invest.com is one. And another one is take a look at allocatesmartly.com. Take a look at both of those, and those are using different algorithms to build portfolios. There's a couple of them that are built on like a dual momentum model, but you'll find that moving averages and a lot of the other things, RSIs and things like that, they just don't perform well at all. It'll be a hard time beating SPY, using a lot of those things. But they have some really interesting strategies and algorithms that are built within those websites. They're very good, actually. The one thing that I don't like about is a logical invest. To me, they tend to change your strategies to optimize them after the fact. So let's say that it performed and got 8% over the last 3 years. They go back and say, oh, how about if we change the strategy to do this and include this product, and also it comes with a higher return. Then they'll show that, oh, historically, this has been doing 12%. Well, no, it hasn't. Because now what you've done is you've got a whole different strategy. And so that's why I don't like the logical invest, but the concepts that they have there are very, very good. Allocate Smartly to me is a more honest website, and these strategies, they typically don't change at all for years and years and years. So when you look at historical performance, you're seeing real performance.
So what are the two websites you said? Logical what?
Yeah,
Can you
one's
put
a,
it in the text or something?
yeah. Let's see if we got a chat session. I'll put it in there.
And are they doing the similar type of things that you're doing, Rick? Is that what you're saying?
They are.
Similar? Okay.
They're similar. I'm kind of taking the information from all these different places, and then I'm doing the research for you. You'll like I said, I can help you do exactly what I'm doing and kind of show you some of the things. But you know, in order for you really to get into those things, you're going to be spending, you know, about $1,500 a year on these services, and you still won't get everything that I'm giving you. So I put those links inside the chat there. So take a look at them.
Yeah, got it. Got it. Thanks. Rick.
Let me give you another one too. And this is that course. And if you want to learn more about this course is very good. I recommend that course. Let me see what this is too. One more thing.
You know, I was almost the first one, right, Rick? The trade dominion one. I was almost trying to register for it, but then I took a step back. I heard good things about this guy. What's his name? Robert De Niro or something.
Yeah, Ron Bertelli.
Yeah. He's a good guy.
Okay, so I'll show you like one of the papers, one of the white papers that strategy is built off of too. I put that link in there too. It's a SSRN paper. So it's a market timing with tactical asset allocation part 2. But they got a lot of really good papers here, and I'd recommend downloading this and taking a look at that. And I can point you to others. But if you want, I can give you probably the papers that build up these are used to build the concepts, the core concepts of the Model 1, Model 2, Model 3.
Oh, that'll be great. Just at the high level, I need to understand it.
Yeah, I mean, you have to. This is the abstract that you get on this page. If you download the PDF, we'll get into the details. It might be a 10 to 20 page PDF, but you'll get enough details that if you want to write the software to go back and do the testing, you can do that then. And let me see. So go ahead and give Ravi your email addresses if you're interested, and I'll send him the discount link or the discount code, and I'll send him the URL to sign up. Again, you're welcome to do it just for a month or two to try it out, just to kind of get a feel for it. But my best friends are all doing that, and they've been doing this now for a couple of years. It's helped us all through this trying period of 2022.
Yeah. The biggest headache is doing all the research, and if someone can do it, that's really nice.
Yeah, I spend a lot of time doing that. Being that I'm retired, I'll probably spend at least 80 hours a week working on this.
Okay. Well, that's really nice.
All right, so I think we're running out of time again.
Yes.
Is there any more questions before we end this?
So Rick, just real quick, Rick. So we are all into this Manusha of zero DT launching nonsense, right? Nowadays, the growth nonsense, I call it as. So when I use your Excel view, right? So the mindset I should be having is what? Growth mindset or income mindset, or what's the mindset I'm getting into using Excel?
For the MEIC trades?
No. He's asking this model, when we're investing in this model with this model in mind, and we are allocating based on this model, will it be fall under the growth bucket or income bucket, or what combination will that be?
Well, I look at it as in growth because it's growing my portfolio. Kind of sometimes the classic sense of growth is that you're investing in companies that are growing their revenues. But these are trading ETFs, and you're not trading companies. And so you don't have the risk of a financial report coming out and messing up your position, or some scandal from the CEO, and destroying your position. And I like that. I like not having individual company risk. I don't have to worry about earnings. I don't have to worry about, some fraud going on at a company, or a takeover, or a bankruptcy declaration, or anything like that. I don't have to look at their income reports or the financials. This is all, trading the indexes or trading ETFs.
Right. So this is basically the growth allocation, what we have here.
Well, and you're making money on dividends. You're making money
Right.
on, on these ETFs as they do go up.
Okay.
So it's really kind of a combination of both.
Combination. Okay.
But I look at it like, if I got a portfolio of $100,000, for example, I don't want to get a 5% return in my retirement. I'd rather get a 10% return in my retirement. If I can get a 10% return every year, then, that's $10,000 extra that I can use to live on.
Right.
And, and so if you were really in a pure income portfolio, you're talking, 3 to 4%, from dividends. And that's not acceptable to me. I want at least 10% on my money.
Okay.
And so that's why.
So Rika, I'm not in close to retirement yet. So let's say I'm looking only for growth, serious growth. Which model will tell me? For model 1 or model 2? Which one?
Well, so model 1 is the most conservative. Model 3 has the highest return between the 3 model portfolios. Index Trader 1, Index Trader 2 should outperform the market, but they're using the ETFs in the market that are indexed. For example, Index Trader 1 is now in the Russell. Index Trader 2 right now is in a VINEX, which is actually a mutual fund, but it's based on overseas returns, and just happens to be that's a good mix. And so they're good. I mean, you could look at it. They were up almost 9%, over 9% last month. And, for you and if you're young and you have time, I'd consider doing as much as 20 to 30% on the Riot 3X. That's going to get you some heck of a returns on it, especially in up markets. And you can wait out some drawdowns. I mean, if your investment horizon is longer, you could wait 2 years if you had to, if it grew down. But this will help you. The Riot 3X like that, if it's averaging 40 to 50% return a year, hey, why not?
Got it.
For me.
So in theory, Riot 3X will also could have a TQQ kind of a ETF too, right?
Riot 3X, they have what?
It could have a leverage ETF too, right? Like TQQ.
Yeah, it will be leveraged ETFs. It's TQQQ, TNA, UPRO, FAS. That's usually how it balances out. It's usually in 2 of those. And then when it goes to a risk off position, it goes to like TMF. The TMF is a bond product, but it's a 3X bond product, leveraged bond product. And again, while they're trying to raise interest rate, bond products suck. So if it does go into a risk off position, it's better to get into something else and just don't trade Riot until the bonds start leveling off or going down, or you're in a risk on market.
Got it. But your algorithm is not going to tell me in advance, I guess, saying that, hey, don't put anything in Riot because market is going to crash. That's not going to happen, right?
It doesn't know it's going to crash. I mean, it's not, it doesn't have that foresight. But if it does start going down, it's going to tell you to get out, where you're going to say, oh, it's gone down. I think it's going to go back up. It's going to get you out of it. It's going to play it safe, where personally I would have held too long and I got myself into trouble. So I like having that telling me, oh, it's time to get out.
Got it.
All right.
I think I'm good, Rick. Thank you so much.
Okay, our time is about up there. So if you have any more questions, you can pass them on to Ravi, or Ravi can forward on my email address to you, and I'll be glad to answer them. And or join me in our Discord group, and I'll answer it there. Thanks for
Thank
taking
you,
the
Rick.
time. Thanks for taking the
Thank you.
time this afternoon, guys.
Thank you very much for your time, Rick.
You're welcome. Talk to you later.
Yeah.